Hello, hello. Welcome to tonight's webinar, where we are going to spend about 40 minutes deep diving the energy sector. Going to be going through a bunch of different historical charts here. I want you to get a general understanding of why this breakout is so important. We're going to look at it from a decades-long perspective. I'm going to go back about 30 years. Weekly and monthly charts. We're going to look at some correlations between energy and tech during certain market environments. We're going to look at some interest rates. We're going to look at oil. I'm going to show you a basket of stocks that traditionally does very well during a period of time where interest rates may be rising. We're going to dive into sub-industry groups within the energy sector. Look at the holdings inside of them. Look at the difference in the types of stocks that each industry group holds. We're going to outline some of the trades that we're already in. We're going to review them. You're going to look at them directly on our market research portal. Then we're going to wrap up the session with actually scanning for new trades. I'm assuming we're going to be able to find at least a couple. Today being a down day might give us an opportunity to open up some trades as early as tomorrow. So give me 1 second. We'll go ahead and start here. Grab anything you might need to drink. The energy sector is exciting, right? Most people don't want to trade the energy sector. Most people complain about the energy sector. I don't see why you'd want to complain about it. Could be some great trades. Okay. So without further ado, let's go ahead and start. First things first, thank you for showing up tonight, giving me your attention on a Thursday night. Let's deep dive at the energy sector. Let's start off with XLE itself because it's kind of the lingua franca for energy plays in general. Obviously, if you've been trading over the last few weeks, it should be common knowledge that energy broke out into a decades-long high. As a matter of fact, if we pull all the way back here, back to 2014, we are testing those highs now. We set a range over the last few years, going back to the peak in 2022. We've gone sideways, not a whole lot of downward action. But if you continuously tried to buy the breakout on the energy sector, which we tried at one point back here last year, we thought this was the time to actually get long. You've probably failed, which is why I think it was so challenging for people to want to accept that energy was finally breaking out. It had been up in this area multiple times, but finally it gave us the opportunity to buy the breakout, and so far it's been a very fruitful trade. And I don't think it's going to end anytime soon. If we bring this into the weekly and we look at the entire thing, and we're going to go through this again with more depth, but let's go ahead and remove all the drawings here. I just want to point out, look how close we are to all-time highs, and is this really a type of chart that you're going to want to short or miss out on longing? This is a potential or secular breakout into all-time highs. 20 years in the making, damn near. And I'm sure you guys are fully aware there's going to be a price target that sounds outlandish, but it's rooted in some facts. We're going to go through it. What I want to start off with here is I want to focus on post-dot-com bubble. Everyone knows about what happened during the dot-com bubble. Markets crashed. We entered a secular bear market. We traded sideways in most of the major indexes for 13 years. It took 13 years from 2000 to 2013 to break into new highs and start running again. So for 13 years, secular bear market. But it doesn't mean that stocks didn't work during that time. They did. Tech went up, post-dot-com bubble, and then crashed again. Energy went up, post-dot-com bubble, and then crashed again. Financials, you get the idea here. What I want you to look at, though, is energy ran from the bottom of the dot-com bubble, 2020 or 2002 rather, to the peak prior to GFC, 364%. Now, the common theme over the last decade has been if you haven't traded growth or been long growth, you've missed out, and that's 100% correct. Growth, particularly the blue chip stocks, have been the place to be parked in cash and be trading for the most part over the last decade. But markets change from time to time. I don't want to tell you that energy is a better trade than tech right now. I'm not here to convince you of that. What I do want to do is show you really quick, though. If you look at XLE against XLK, and you go back to that time period from 2000, so right when the dot-com bubble burst, all the way through 2008, energy was the better trade. Energy outperformed tech for 8 years straight. Once again, I'm not saying that's going to happen. I'm saying it has happened, and I'm saying it could happen again. I'm not saying it will, but I'm opening up the idea here because a lot of people complain about having to trade energy. It's boring. It doesn't move enough. Totally understand where you're coming from. Duration style trades definitely take a certain type of trader to sit in them. But sometimes the market is not going to give you underhanded growth trades to smack out of the park. You're going to have to go and find where the opportunity is. Energy against the Qs. What do you think it's going to look like? Energy outperformed for 8 years straight. Once again, not saying it's going to happen. I'm telling you that it did happen. It can happen, and it probably will at some point happen again. Not saying right now, but I want to get through that. I want to cut through the noise right now. Hopefully, if you're the type of trader that shuns away from some of these longer style trades, the duration style trades, the lower ADR style trades that sometimes we talk about, I hope this is shining some light that steering certain market conditions, these are the trades to take. These are the sectors to be in. Once again, 8 years straight. I want to go through 10-year yield really quick, and then I'm going to show you why this matters. 10-year yield has been on a warpath. I posted this chart early last year, and I'm sure you guys can agree, it looks ridiculous, at least the intent of what I'm trying to say here. Am I really saying that the 10-year yield is breaking out of a base that it lasted in for 10 years and might now be entering a period of prolonged uptrend? Could I possibly be saying that? Is that possible? I have no idea. I don't get paid to speculate on that. I do know that it's happened before. The early 1900s all the way to 1980-ish, we were in a period of raising rates. Market went up. From 80 to 2012, rates went down, market went up. From 2012 to 2022, rates went sideways, market went up. From 2022 to 2024, rates are going up, market's going up. Once again, I'm trying to smash this false idea that a raising rate environment does not necessarily mean the markets are going to crash. In the short term, they might. Not crash, but in the short term, there might be headwinds for sure. Regime changes take markets time to adapt. But once again, if you pull up the SPX chart and go out, it's an uptrend pretty much the entire friggin' time. Does not matter. The market will adapt. Why am I bringing this up? Well, I'm bringing this up because, let's bring this down to, well, we can leave it on the weekly. Correlation coefficient is a fantastic indicator. It's free on TradingView. What it does, obviously, is it shows you how correlated two assets are based off of price. And as a technical trader, that's what you should be focused on. The 10-year yield against the energy sector. Do you expect it to be highly correlated, highly inversely correlated, or exactly neutral? We go back on the weekly, and it is absolutely more correlated than not. I'm not saying it's a one-to-one, but yes, going back 14 years, the 10-year yield and the energy sector tend to be more correlated than not. Once again, just like we were talking about with XLE from 2000 to 2008, in retrospect, it was the better trade than tech at the time. It outperformed tech. I'm not saying it has to happen, but it has happened. Same idea. Not saying that rates have to continue to go up. I'm saying that they are going up and they have done it before. And that energy tends to respond well when interest rates go up. There is no prediction. There's no opinion. It's data, and you can see it. If the squiggly blue line is on the upside, above zero, more often than not, it's more positively correlated. If this line goes up, there's a general understanding that energy is probably going to go up as well. Let's look at U.S. oil. Let's remove the correlation coefficient really quick. Should not surprise you to think that U.S. oil prices and U.S. domestic energy producers are probably correlated, right? Makes sense. As most commodities-based equities, the underlying asset going up in price is probably going to reflect well on the company that you're trading. So as oil prices go up, which they are right now, they're not breaking out by any means. I'm not here to forecast oil prices. I have no idea. I'll tell you, in the south of Brazil, oil is very expensive, or gasoline at least. Very expensive. Not sure where you're checking in from, but it's expensive down here to fill your car up. We're stuck in a range from above about 70-ish to underneath about 90-ish. We've been here for almost 2 years straight. Once again, I'm going to prove to you that oil prices and the energy sector are more correlated than not. If the 10-year yield in the energy sector were correlated, this is very, very correlated. Very correlated, meaning the black line you see for U.S. oil tends to track or front run, depending on who you want to talk to, energy prices of the equities, or energy prices, excuse me. So if you're in this mindset that U.S. oil is probably going to break out, energy is probably going to break out. But guess what? Energy already broke out. So is energy front-running oil? I don't have the answer to that, but it's something to think about. Is the stock market expecting oil to break out into new highs, and they're front-running it by owning the energy stocks? Something to ponder. Let's take it one step further. We know that oil is correlated with the energy sector highly. How about oil and the U.S. 10-year? Once again, yes. More often, yes. So 10-year rate goes up, oil prices are probably going to go up. If oil prices are going up, energy stocks are probably going up. You see how we're kind of building out this idea? And it's not based on opinion or bias. I don't really give a shit, to be honest with you. I care about making money in the market. I don't care about what the price of gas is. It's going to suck, don't get me wrong. But if I can make money trading that, it'll be nice. That's my job, to figure this out. So the 10-year yield's in an uptrend. Oil prices are stuck in a range, and XLE and energy stocks are breaking out into new highs. A lot of them all-time highs. Reasonable to expect U.S. oil is going to break out. Probably. I don't have a trade on that, but it's looking like it probably will. So we've talked about a raising rate environment does not necessarily kill the stock market. It's happened before. Many times. Give you guys a little trick here. Not necessarily a trick, but EQRR. This is your equities for rising rates ETF. Broke out into all-time highs. This is the weekly, so it broke out 2 weeks ago. This particular ETF holds stocks that hold a high correlation to the 10-year yield over the last 3 years. Once again, for the people that think rates are coming down, I'm not here to argue with you. Joe Biden is in your camp. He says rates are coming down, baby. Maybe they are. I have no idea. Market doesn't think so, though. Market is calling their bluff. Stocks that hold a correlation to the 10-year are breaking out, and this particular ETF is at all-time highs. I'll take it one step further. I do not get paid to show you this. I'm not shilling it. But COIFIT. We can do a little ETF deep dive here, which we're going to do later as well. You can look at the different types of stocks that are within this ETF and the sector breakdown. Little fun fact, interest rates going up tends to do well for multiple sectors, not just energy, financials as well. So energy constitutes 31% of this ETF, financials 20%. So 51% of this ETF is energy and financials, and it's at all-time highs. Once again, this is not the end of the world, folks. If interest rates go up, things will still go up in the market. You just have to figure out which things those are. The S&P 500 Energy Index, which is slightly weighted differently than XLE, is already at all-time highs. XLE is almost there. SPN already is. This is an all-time high for the S&P 500 Energy Index. Once again, I'll give you the holdings. Here you go. Screenshot it. Do whatever you want. SPN. It's a little less important than XLE. That's all right. We'll still take it. Let's look at XLE one more time. And let's look at it from a price target standpoint, weekly. So you can see how we're trading XLE right now. We obviously have positions. If you guys have been following our content or on the newsletter, you have some of these positions with us. We're going to go through them in a second. But we're trading this last 2-year fractal. We're not necessarily playing this 20-plus year base that's starting to break out. But I think it's fair to talk about what happens if we break this 20-year base. What happens? What are the implications? What are the long-term trades we can put on the books? For those of you that don't like playing past Friday, this might scare the shit out of you, but what happens if you open up a 2025 contract? There's some 2026 contracts available. Not saying you have to, but man, that sounds great in a sector that's breaking out into new highs, something you don't have to worry about on a day-to-day basis. So what I want to do here is I don't want to delete this, so we're going to have to work through it. I apologize. We're going to just draw some basic fibs here. We're going to play previous levels. Draw a basic price target, whatever you want. It doesn't necessarily have to be perfect, but this is how I would play it. My price target is in between 130 and 140, something like that, off of a 92, 95 area. It does not have to be perfect, guys. Remember, when we're swing trading and we're looking for $5 to $10 to $15 moves, a dollar or two difference between price targets, etc., not a big deal. Is it unreasonable to expect an XLE breakout hitting 135 over the course of a year or two? And what are the implications of the companies within the sector if it does happen? Once again, I'm prefacing if. I think this is going to happen, but I don't have a trade on to necessarily express this. Actually, I lied. I do. I do have a trade on this, but I'm not out there publicly talking about it yet. What happens if this does happen? What types of trades do you think will make the most sense? And do you want to trade in a sector, for example, XLE, an ETF, or would you rather go and trade an individual company? I don't think this is out of the realm of what could happen. And before anybody scoffs at me, which is totally fine, I've been called some very bad names over the last 2 weeks. How dare I tell people to buy Amazon and Google? They're both at all-time highs today. I'm a big guy. I have thick skin. It's all right. What happens if this does happen? The same guys that are saying this can't happen were the same people that laughed at traders that were buying the bounce in 2020 that ended up being that V-shaped recovery that should have never existed, and yet it did. Same guys that are saying this can't happen were saying that we were not going to see all-time highs in the end of 2023, beginning of 2024, and it happened. There's a million things. Don't get in the habit of predicting in opinions. Focus on, if you're a technical trader, price. What are trends telling you? What are levels telling you? This absolutely could happen, right? It can, absolutely. So let's move on to industry groups really quick. We've talked about the overall sector. We've looked at SPN. We've looked at XLE. Those are two very big and important energy sectors, and we're going to go through them in KoiFin later. But I want you to understand where I'm coming from and why this all kind of ties together. All of the moving pieces are kind of pushing us in the direction that energy. This is a play you're going to want to take and stick. So this is a higher beta industry group, XOP. This is your oil, gas, exploration, and production ETF, XOP. I have a cute little triangle there. I don't trade triangles, just so everyone's fully aware. But that was a consolidation fractal into a breakout. This is an uptrend. It's just as simple as that. It's as simple as that. Uptrend off of the 2020 lows after a 5 or 6 year downtrend. It's a trend reversal. Probably want to get in on something like this. If we go and look at KoiFin really quick. Bring this up. Come into XOP here. Holdings. Look at the types of companies that are in here. You can look up here. You can look down here, whichever you want. These are the large oil and gas exploration and production names. They generally have some market cap behind them. A lot of these are names that you guys are probably trading. Exxon, Chevron, Marathon, ConocoPhillips. I think the Warren Occidental. There we go. We got Berkshire. So XOP is going to be probably the most widely traded industry group within energy, it has more of the higher beta, higher liquid stuff on the chain. So if you're options trading, you always have to make sure that there's actually a trade available on the chain. You can't just go, well, you can. All right, discourage this. Don't just go and buy something with zero open interest, zero volume, and a spread of $3 between the bid and the ask. Probably not a great trade. But this particular sub-industry group of energy, XOP, is going to hold a lot of real liquid traders. And a lot of these, ironically, are up or near all-time highs. Really quick, because I forgot, I want to show you something. I've sent this out into the newsletter, so you probably already saw this. But energy is now leading on the year. Once again, doesn't have to lead necessarily, but it is right now for whatever reason. Little conspiracy theory, I guess. But if you go and you look at your, I don't know if I should say this. Someone's going to comment back, well, no shit, dude. Your aerospace and defense ETFs at all-time highs. Oil's breaking out. Gold's at all-time highs. Energy companies are at all-time highs. I don't know. Maybe the market's telling us to fucking watch out. Maybe something's brewing. Geopolitical scene. I don't know. It's not my job to figure it out. Year to date, XLE is up the most, but let's take it one step further really quick. If we bring this back to 2020 and we go all the way back to the March lows, which I think are the 23rd. I think this is the absolute low. Someone's going to fact check me here. Check this out. Once again, I'm not trying to tell you energy is the move all the time. What I am telling you is energy has been the move since 2020. If you bought the 2020 lows in energy, you have made more money than everybody by a lot. And that's after a 2-year consolidation phase. Once again, this is not my bias or opinion. This is the exact 2020 low, March 23rd, into today. Energy was the better trade. Most people probably don't know that. I didn't know until I looked it up. Let's go one step further. Industry groups are going to have underperformed because semis are so friggin' strong. But XOP is up the second most. AMLP and OIH. We're going to go through these right now. So let's start with OIH. This is going to be the second most liquid sub-industry group to trade within energy. XOP being number one. Once again, this is going to be filled with some names that you've probably heard of. Schlumberger. We had to YouTube that 3 or 4 years ago to make sure we were pronouncing it right because we were calling it Schlumberger. It's a French company out of Texas. Imagine that. Halliburton. Everybody knows Halliburton. And go down the list and you can see these are definitely smaller types of companies. So this is your oil services. They're different. They're smaller. Some of them have liquidity and some of them don't. It's going to be tougher to trade some of these on an options chain at least. But once again, oil services are doing good, having a good year. The last one, AMLP. This is going to be a weird industry group in the sense that they're going to have a lot of pipeline names, different types of companies that don't quite fit into XOP or OIH. These can hold some fantastic trades, but they're going to be niche trades. I'm going to show you one in a second. Niche trades. These are going to be the very, very slow-moving names. Not saying they're necessarily a bad trade if you catch the right breakout, but these are the names where you're going to probably want to buy 3 extra months of expiration instead of 1. They just take a while. That's not to say that they don't work, though. They do. So those are your 3 main energy industries, at least on Koyfin. There's a bunch others, right? We have uranium, which we're going to see on the scans. We have coal, which we're going to see on the scans, and we have a current position on, which we're going to go through. There's a lot of different weird sub-industry groups within energy that I encourage you, as we go through the scans in a second, to think about owning. The way that we approach this inside of TTI is we don't necessarily want to just own Exxon. We don't want to just own Exxon and Chevron, both of those being the large/mega cap XOP related names. We want to diversify across different industry groups within the energy sector, both based off of industry and based off of beta, which I think is an important factor that most people don't think about. If you have an energy portfolio entirely comprised of gas pipeline names, you're probably going to make some money in an environment where energy is being bought. But holy smokes, it's going to take a long time for you to make that money. These things don't move very fast. Now, conversely, if you have an entire portfolio filled with only uranium and those things move 8% per day, you could make $1 million and lose $1 million back to back. So what I'm trying to say is we like to maybe buy an anchor name like an XOM, like a Valero, like an MPC, large cap, medium mover, 2% ADR. Then grab some coal or uranium that might move 3 to 6%. Then buy some oil gas pipeline names that might move 1%. So we have a diversified grouping of energy stocks across industry groups and beta. The reason why I like that is when the market pulls back violently, you're not staring at a position group of 6 that are down huge because they're all high beta stocks, and you're like, oh my fucking God, I don't know what to do. You don't want to do that. I want to try to make this as easy as possible for us. So think about that as we go through the FinViz portion. So let's talk through really quick because some of you guys are in these trades, and I'm sure some of you are curious about what we want to do with some of these. So let's actually look. Let's go to Valero. Trade we took and we sent out on the newsletter March 8th. Here's the actual trade as it looked when we took it. It's a very basic setup. You're probably going to see this a lot, at least with us. Range breakout. It's nearly the exact same setup as XLE itself. Don't have to reinvent the wheel here, guys. It's an uptrend into a consolidation fractal with an overhead resistance area that you can play the breakout of, and we did. You can see the ADR at 2.64. So once again, it's not a super slow mover, but it's not a small cap, high beta growth stock that's going to move 8% in a day. At least that's not what we thought. You can see that we have the sector information. It's a large cap at around 50 billion at 2.64. We liked it above 147. Our stops at 138. We have a couple price targets, 177.5 and 200. You can see the play that we took, the September 175s for no more than $5. Once again, we go over to TradingView, and a bunch of you guys are probably in this if you're here from the newsletter. Let's bring this into the candle and go to the daily. You can see that we tapped our first price target. Now, this was interesting to me because when we took the trade, we didn't necessarily expect it to move as quickly as it did. We were just talking about the importance of kind of diversifying beta groups or different groups of beta within your portfolio. This was one of these trades where we thought was actually going to take a little bit. As a matter of fact, in the newsletter and on the trade idea, it said it's probably going to take like 6 months. It didn't. It took about 2 weeks to hit our first price target. It's not normal. But when Valero started running like this, we started having internal conversations in TTI like something's going on with energy right now because this stuff doesn't normally move like this. So we tapped our first price target. We were able to get out half at 100% within the first few sessions, take some profit off at 177, and then obviously we're going to leave the rest to go. And it has, another 4 months at least of expiration before we have to manage this. If it doesn't work or if it wants to consolidate, we're in the best possible situation here on Valero. So this is an XOP related name that we grabbed over a month ago, and it's working. If you're in it, congratulations. If not, this is the type of stuff we're going to look for in a couple of minutes. The next one I want to go through because we also sent it out on the newsletter, ETRN. I personally didn't grab it. This is a different type of setup. If you've been watching any of our content, you could probably tell right away what this is. This is a stage 2 breakout. Little Richard Wyckoff, Stan Weinstein-esque. We liked it above 11.5. I mean, this is pretty friggin' simple, right? Range was set for 4 years. You buy the range breakout. 2.57 ADR. Once again, it's a little bit higher mover than what we would normally expect with this sub-industry group, but everything looked pretty good on this setup. Go back and look. We liked it above 11.5. Risk off below 985. Profit targets at 16 and 20. This was a shorter term play. And actually some news came out after we took it. There was potentially somebody looking to buy this company. So it did change the dynamic of the trade, but because I know some of you guys took the trade, it is up right now off the 11.5. About 11, 10 to 12%, something like that. Not a bad little trade here. Contract should be up near 100%, if not a little more. Next one I want to go through really quick that we didn't actually post on Circle, but I want to give some light to it because we traded it last year for a win. It wasn't a huge win. I had very high expectations for MPC, but this is, I think, in my mind, this is the market leader. I mean, look at that's the entirety of MPC. This is the market leader. We had identified this last year when we were getting long in August. We wanted MPC. It worked pretty well for us, consolidated, then broke back out. A couple traders inside of TTI grabbed this off of this. It's the same setup as Valero. Consolidation fractals and uptrends by the breakout. Not saying it was a super easy trade, but this particular trade ran for 800 to 1,000% for a couple of the guys in TTI. I didn't take it, so shout out to them. But once again, I want to point out that this is not a tech trade. This is an energy trade. This is a large cap energy trade. Just to point out, I know that some people don't like trading this type of stuff, and I get it, but when certain market conditions call for it, this is a large cap energy trade that traded like a high beta growth stock. XOM was the most recent one that we put on, and I think a bunch of you guys also grabbed it because we put it out on social media. Now, this is, I think, probably one of the safer trades that we put on, and by safe, I mean look at the ADR difference, 1.35. Valero was almost 3. MPC was almost 3. Even ETRN was almost 3. We look at XOM, it's a giant, it's a behemoth. As a matter of fact, it's the largest energy stock in the energy sector. Here's the write-up. We just opened it on the 2nd or 3rd of April, but it went out on the 2nd. Here's the setup, and we're not that far off. Right? This is a behemoth of a stock. It's going to take a while to get moving. Matter of fact, this trade might still be available. We liked it over 120 with a price target of 135. It's a 1.37 ADR, meaning it's probably going to take a lot longer than some of these other trades. An accommodative 200-day moving average sloped up, price up and over it, breaking out into all-time highs. RSI was at the moon, screaming to us that buyers didn't care what they were paying for it. They wanted in, and that's the type of stuff we want to own. We want to own things that are overbought in many circumstances because it tells us the market wants it and doesn't care what the price is. That's generally pretty good for momentum. And we're a momentum-based trading group. Mega cap at 470, 1.37 ADR. We wanted to own it above 120. Risk off at 115, price target 135. The October 18th 135s for no more than 250. Now, this was a challenging trade to get filled. I'm not here to shill you the development program, but one thing that we do inside of Discord every day is we monitor some of these trades that might get away from us at first. XOM, we didn't want to own it above 250. The very next day after we put it out, some guys got filled below 250. It was trading at like 260, 270. For some of you guys, you might go, well, I don't care. I'll pay the extra 20 cents. We don't. We do not. We stick to that rule. If we have a hard rule on the books of we don't want to pay more than whatever we're willing to pay, we do not chase the trade. That price level is baked in through looking at previous options pricing history to see if we're getting a good enough discount on the contract and making sure that we have the risk reward that we want. We don't want to pay an additional 50 to 100% more than the asshole that bought it yesterday, the day before. That would put us in a really bad situation if the stock pulled back. That guy might be able to hold it. But we just paid a premium to get in, and then it's not working. It's incredibly challenging. So XOM was challenging to get into because at 250, there was no entry for a while. And then finally, we started to get filled. Valero was the same way, by the way. I don't know if Riley's in here right now, but we have a newer trader in the group named Riley who was stalking Valero and added everybody in Discord and was like, by the way, contracts are ready to go. And we had like I'm not kidding, 13 or 15-minute window to get filled on Valero. So shout out to you, Riley, for being on top of that. But here it is, XOM. Pulled back in towards overhead supply. This is what we would consider a BRB setup and bounced. The contracts are probably up slightly because of today's drawdown intraday. You know how options contracts work. So this is something that you could potentially be looking at owning. XOM is a fantastic setup. You could play the same contracts as us if you want. Once again, we bought the October 135s for no more than 250. If I actually pulled those up really quick, I don't know what they're going for. October 135s. Nope. You are getting priced out. That is incredible. They're going for 335 right now. Never mind, folks. We're going to find something else because you guys are going to get screwed. It's the same trade idea, by the way. Isn't that crazy? This is why I love options. If you can wait for a discount, it's the same trade idea as the guys that bought it at 120. You're buying it at 121, and yet the contracts are up 35, 40%. Chasing here would be really a bad idea if you're using the 120 level to risk. Last one I want to go over really quick because I want to spend about 15 minutes on Finviz, actually scanning through this stuff so we can find some new trades, is NXE. And the reason why I want to bring up NXE in particular is because it's a high beta energy related trade, but it's coal. So we were talking earlier about diversifying across different betas. It doesn't necessarily have to be oil related to be in energy. This is a coal related name. I think it's kind of funny that they delisted the coal ETF and then coal went on to absolutely rip everybody's face off that was short. And now you have all-time highs in a bunch of coal names while everybody's still complaining about renewables. If you look at PBW, your clean energy ETF, you look at your TAN, your solar ETF, these have been absolutely terrible investment and trading vehicles for the last few years. And then you have coal that's in like all-time highs, a bunch of them. It's just ironic, right? That's why I always try to tell people, don't try to make sense of this stuff. If you look around to your left and right and you try to make a trading decision based off that, it's probably not going to work. It's just not. Here's the trade on NXE. We originally wanted to buy it above 650. We did not. We missed it. Can you see the fractal that we're looking to own? Continuation. We wanted it above $8, I believe. Risk on above $8. It's a mid cap, by the way, so we were looking at large caps for the most part. 5.33 ADR. I hope this is starting to get through to you guys. Think about XOM at 1.5, Valero at 2.7, MPC at 2.8, ETRN at 2.7, and now we have a 5.33. So once again, all the stuff that I was just talking about, hopefully I'm like not only preaching to you guys, but showing you through application. This is how we do this stuff. We want to stagger betas through our portfolio. It makes trading infinitely easier. And when we catch a trend, the high beta stocks tend to do better than all of them because they're higher beta. They're going to move more than the benchmark. Own it above 8, risk off below 740, price target $10. The November 10s. The reason why we like those November 10s is when we were looking up this trade, there was somebody buying thousands of these contracts. Thousands. And we liked this. So we said, why not just follow the guy that's buying thousands? Makes total sense to me. And so we did. Now, the trade has been whippy, to say the least. We're still in it. We got the initial break, pulled back, and now we're bouncing. So here's the trade as it is right now. Slightly up on the contracts, but this gives us exposure into a different area of the energy sector that's higher beta. Personally, I did not take SM, but many people did. I have no idea what happened after hours, but it's still a great trade. I know that this is a free trade because we've talked about it inside of the Discord group a number of times. So if something fundamentally changed with SM and you don't like it, we'll figure it out tomorrow morning. But good job on catching the breakout here at 42.43. I do not own SM. Let's talk Finviz. Show you guys how we scan through this stuff. Use whatever scanning software you want. Does not matter. We use Finviz just because it's easy and I can share links super quick with other people that want to join in on the scanning session. If you have a different piece of software, feel free. It's all relatively the same. Most important part of a scanner is knowing what the hell you're scanning for. Well, we know we want to scan for energy, so the first thing I would do is go to sector and click energy. It doesn't seem too difficult there. We have 258 names that are listed under the energy sector. This includes all market caps and all performances. Something else I'll generally like to do is append some sort of price filter. I don't want to own or trade anything under $10. They're usually shit tickers. I don't want to trade them. 175. We've whittled down the list from 9,500-ish to 175 so far. Volume is probably a pretty good thing to append as well. And because they keep adding things on here, I can never remember where volume is. Where is a volume? I love you, Finviz, but why do you keep doing this? Relative volume, average volume. So average volume over 500,000. Now we've whittled the list down to 116. Why does volume matter? Well, things that are trading under 500,000 generally are not going to have any real volume on the chain. Speaking of chain, let's make sure there is one, optionable and shortable. 116 names. This is before our performance filter, so we've whittled down the list like crazy. We only want to be looking at things over $10, average volume over 500,000, optionable and shortable. Now we can do some sort of performance. What do we want to do? 50-day highs, 20-day highs, 52-week highs. Let's go with 50-day highs first. It's kind of the standard quo. Probably going to find some names here that look okay. So let's go ahead and go through these. Generally what I do when I start, I go through overview. If I'm not specifically in a sector, I'll go through overview and click sector, figure out what types of sectors are trending on the list that I'm looking at, whether it's good or bad. And then I'll click over to charts here. And what we look for in setups in TTI, most of the time, are horizontal level breaks. You can scan through hundreds of charts quickly using FinViz if you know that you're looking for horizontal level breaks. I'll give you an example. GLNG, horizontal level break. This one might not be a trade because it looks like it already broke and it's up. But it's very simple to see. Is there one here? There certainly was. Is there one here? CVE. Absolutely. As a matter of fact, we opened up CVE at the end of the day today. Once again, you can see it's a horizontal level break. So what we would do is go back over, type in CVE, and lo and behold, what do we have here? Certainly looks like a potential horizontal level break to me. Uptrend off of the 2020 lows, consolidation fractal into a potential 2-year high breakout. Breaks the 2022 high, and you're in a decade high break. Yeah, this is absolutely something that we could possibly own. Doesn't have to be perfect. Draw a line in the sand and say, I want to own it above a level. I want to be cautious below a level and have a stop. We use fibs to figure that out. I'm doing this quickly, so please don't kill me if it's not perfect, but we'll use 21. Draw to the bottom of the range. We'll probably draw it there. Multiple points of confluence. $21 is our risk on. 25 is our first profit target, which I guess coincides with the previous run-up. If it gives you a little more confidence, that's good. And a stop below 1970. This is going to be a 2.8 or 3-to-1 setup. 2.8. You can bring up the stop a little bit if you want to skew the risk to reward because of the BRB today. Let's talk through this. Reason why this caught our eye at the end of the session, because it got the breakout and then energy sold off today. I don't really care why energy sold off today. I really don't care at all, actually. The news could be OPEC related, war related, Biden related, SPR related. It doesn't matter to me. I do not care at all what the news is. What I care about is we broke and pulled back in towards an overhead supply level, which gives us an opportunity to buy discounted contracts for the same idea that somebody else bought the breakout of just a few sessions ago. There's a strong possibility that this bounces. Doesn't have to necessarily bounce right at this level. It could undercut it slightly and then bounce. But if you're getting a deep enough discount on the contracts, it's probably worth your attention. Not necessarily buying, but attention. So we did. We like this. This is an integrated oil name. 40 billion market cap, 11.37 million average volume with a 1.76 ADR. Probably the same type of trade as an XOM. Going to want time on this. But if we shift click up, we're looking for an 18% move off of a 1.76 ADR. To some of you guys, that might make no sense, and that's okay. That's why you're watching this. But would you be willing to buy a May or a June contract with something that needs to move 20% and it only moves on average 1.76 from peak to trough per day? Probably not. You're probably going to want to buy at minimum 3 or 4 months. So if we go out to the chain, which ironically I have up, CVE, probably going to default to those Septembers. Probably going to want to go out 162 days on something like this. You're going to want time. It moves slow. You're looking for a 20+% move. Our price target was 25. December's, I would normally be on your side, but there is none. I like where your head's at, Joey. I have no problem buying December's, baby. But yeah, there's nothing there. So $25 calls here. That volume is us. That was us. We bought these for in between 50 and 55 pennies. 31.6 IV with the 31.6 IV rank gives us a very strong chance of IV expansion at the breakout point. So this is a trade you could potentially take with us as early as tomorrow morning. $25 call, September 20th, CVE. More of a duration style trade. If you're expecting a high beta growth-like move, please don't take it. If you're willing to sit and wait a couple weeks, a couple months for your profits, not a bad little setup to take. Right? Let's go to the next one. Devon. No idea if this is a good trade or not. This is the first time I'm scanning through this with you. We do have a guy that's already in Devon. I have a personal hatred for this stock. But yes, there's a potential entry here. Cut the range in half. Multiple points of confluence. Doesn't have to be perfect. I'm doing this quick, so I'm sure someone's going to screenshot this and upload it to social media and be like, this guy fucking sucks at charting. Just trust me, I get it. All right, just work with me, please. Cut the range in half. This is the exact same setup that we took for CrowdStrike, the exact same setup we took for Uber. Both of those were triple-digit wins. The Uber trade is like our third trade on the books for a triple-digit win, just absolutely bonkers. But you can see that previous support has turned into resistance. It's not that difficult. Defense, 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 flip, resistance, resistance, resistance. What happens here? No idea, but energy's breaking out, so probably a pretty good opportunity to own it. 200-day moving average is starting to slope to the upside, which is what we like. RSI is screaming that we want it. Earnings are a couple weeks away. 1.6 ADR means that this thing's going to move slow. So if we do take this trade, the expectation is once again, probably buy time. Own it above 55. Spitballing there. Stop out below 51.5. Price targets at 65. Probably going to be close to a 3-to-1. Stop out at what? 51.5. 65 for the price target. 3-to-1 setup-ish from a shares perspective. Not bad. Break-even win rate on these, you take 100 of them, is 25%. Win more than 25% of your trades, you're making money. Let's go to the chain. I have no idea what Devon's going to look like on the chain, so don't kill me if there's nothing. Isn't that the plight of a swing trader, though? Everything lines up on the chart, and you're like, I'm jacked to take this trade. And you go and look at the options chain, and there's friggin' nothing there. It happens quite frequently nowadays. Let's go out to the Octobers. I mean, this thing moves pretty slow, so we're going to Octobers or Decembers. Price target was 65. We're looking for a 0.25 delta for confluence. See if there's something there. There's a 0.2 delta and a 0.26 delta. Absolutely. This could be a trade. Let's look at the Decembers really quick. I'm kind of on Joey's side here. If you can open the Decembers, why not? Yeah, $65 Decembers. 50 volume on the day, 2.65K open interest. We're not the only assholes in the world with this idea. We can look at the options pricing history and see if we're getting screwed on the contracts, and boy, we are. This is a very expensive contract compared to what it has been, but I guess it makes sense because the name has been progressively doing better. But this is why we like to buy pullbacks. Because the guy that bought this last week paid $1.50 for it. I know you're paying $1.80 something for it. And that matters over a large sample size of trades, especially if you have a couple bucks in your account and you're buying 10, 15, 20 contracts. That difference can be huge. So the Devon 65 December is not a bad trade. I like it. The problem is the contracts based off previous pricing history a little expensive. So what can we do? We love Devon. What can we do here for Devon if we wanted this, but the contracts are a little bit too expensive? So one of two things we can do. We can wait for a steeper pullback, but do you want to own the pullback if it already pulled back and the contracts aren't down? I don't know. Would you want to own Devon if it opens up tomorrow and it's down here? Probably not, because at that point it's not clearing overhead resistance. What I would do for Devon is wait for the break and then the pullback, just like we did with CVE. There's a good chance the contracts are going to be slightly down. because people are going to close expecting that they bought the top, if you will. It's going to exasperate the selling pressure, and you're probably going to get somewhat of, I don't want to say capitulation, but you're going to get an extended move to the downside off of the breakout. We see it all the time. Maybe we can snipe some contracts on Devon then, but I'll give you another little hint. Inside of TTI, we work with guys that generally, and girls, that generally have larger accounts. So we have accounts of 6 and 7 figures, and we're buying calls at all-time highs. The contract pricing doesn't really matter a whole lot as long as we're getting a good deal. Right? We'll go out and buy a couple $1,000 contract as long as it's a good deal. But there's also some guys in the group that are learning the system and they don't feel comfortable trading with a lot of money, which makes total sense. So we can always call debit spread some of this stuff. So if we like the 65s, what can we do to reduce the price? Let's say we don't want to pay $1.82 for whatever reason. It's too expensive, whatever. Call debit spread it. It's good and it's bad. It's good because you've now reduced your price point from $1.80 something to $77, which is great. If you have a smaller account, spreads are your friend. You do also have a max profit. Right, so straight calls, the theoretical max profitability is infinite. Not saying that'll happen, but it's infinite. That's the part of the reason why we want to own calls in an all-time high environment, specifically with low IV. Think Google, Amazon. If you guys are on the newsletter, you saw the Google play. We liked the 195 calls for a reason. We didn't want to call debit spread that. When IV explodes, those contracts are going to juice up in premium. Call debit spreads do not reflect that juiced premium if IV expands. You get the directional play, but you don't get IV expansion. So there's some good and some bad about spreads. You're reducing your cost to get in, 77, max profit 423. So this is a very healthy, like 5 or 6 to 1 setup. So for every dollar you're risking, you're looking to make max $6, something like that. But you're capping your potential profits. Not that big of a deal. I love call debit spreads. Some people absolutely hate them. But once again, if you're working with a limited budget or maybe the contracts are too expensive, puts you over your 1R. You don't know what that concept is, go watch the small account webinar I ran 2 weeks ago. Call debit spread these. Would you ever get in now and then add on? Absolutely, yeah. Probably a topic for another day. Yeah, absolutely. We will cut our buy orders up. So if you have 1R, here comes the infamous paint tool. If your one standard risk lot is, 5,000, your 1R, we could do something like a 0.5R. We talk about this on a trade-by-trade basis. It's very discretionary in nature. But a 0.5R on the breakout, and if it pulls back, we'll buy the other 0.5R to get fully positioned in. Absolutely, you can do that. There's risks. If it doesn't pull back, you're now in a breakout with only 0.5R. If it pulls back and you fully size in and then it continues to break down, which occasionally happens, stuff happens. Market's crazy. But yeah, absolutely, you can break up your buys. And people do that. I will say that we ran, over a large sample size, we ran an experiment on front running the breakout and then buying the pullback. And we were using above 1 RVol as our metric. So if for anyone that doesn't know, above 1 RVol, there's a better chance of a pullback over the next 3 to 5 trading sessions, about a 65 to 66% chance. That's our BRB is based off of this fact. Horizontal level, high RVol breakout, good chance it pulls back. When we ran the numbers and we ran with real money, we would try to front run and then add on the pullback, and it just never worked out as well as just buying the full position at the same time. I'm not telling you what to do, but we profited more having one buy than two. But certain circumstances, it's totally understandable to we leg into a trade, right? So absolutely, you can do that. Don't be afraid to size in though. So DVN, available trade, there's 2 different types. You can calls for 65. You can call debit spread for 65, 70 for the Decembers. We have the CVE trade, which we grabbed earlier today. Let's try to get at least 1 or 2 more before we call it a night. It's already been 55 minutes. Let's see here. And I hope at the beginning of the webinar, when I kind of like built this whole idea out, that this is probably not going to be something that we're only going to be trading for like a couple weeks. Maybe energy doesn't front run and lead the market for the rest of the year or whatever, but I have a sneaky feeling. And if you think assets trend, which I tend to think that they do, prices trending into an all-time high after a 20-year base is something I want to be a part of for a while. NOG, Northern Oil. Let's see what this looks like. Don't know what that was, but that doesn't look like something I would normally draw. It worked, though. I'll take credit for it. Yeah. I mean, why not? It's not my favorite setup. Just a massive base. Going back to 2015. I don't think I've ever seen this name on any trade ideas we've ever had. It doesn't ring a bell. So I'm going to go ahead and check the chain to see if there's even anybody willing to trade this before we chart it. Look at that. So if you don't know what that is, folks, that's an elephant print. Somebody loves this stock. Probably it's one single buyer. You guys are getting a forensic lesson in options trading. Certainly looks like one single buyer. 700 bought, 300 bought, same price point, 225. So somebody loves NOG. All right. That's convinced me to, at the very minimum, chart it. It's Billy. Maybe. Billy owns everything under the sun that we talk about. He's had a fantastic year because of that. So good job for you, Billy. 67.5 on the price target. This is a massive base going back almost 10 years, 9-year base here. 67. Is this reasonable? I'll tell you right now, if this is a 1.83 ADR and we shift click up, this is going to be a massive move. Yeah, we're going to need, if you're looking for that, that's a 2025 expiration probably. And most people probably don't want to do that. So we're going to be more realistic and we're going to go with like a 0.25 delta or something like that. Let's go out to the Septembers and see the $50 calls, the $45 calls. It's not a bad setup and somebody loves it. The liquidity kind of sucks on the chain. I'm not super jazzed to own stuff that are inside the 0.25 delta. This intrigues me though. There's one dedicated buyer. It doesn't look like there's anything on the put side to show you that. Yeah, I think we just found something kind of cool to keep our eyes on here. So NOG. If you want to follow somebody that has a probably has a very bullish directionally biased trade on the books, there you go, your $45 call. I'm not going to follow that, but I would prefer to own the 50s under $1. The 50s under $1 make more sense to me. It's a 0.22 delta, which is pretty close to our 0.25 sweet spot. You're going to get the impact of the breakout if EOG breaks out. And if it continues to run, what was the... If it continues to run, you're going to be in the money at 50. But yeah, it's not a bad little setup. I like it. I think that the options chain kind of sucks, but somebody loves it. So if you like that type of stuff, you want to tail somebody that has a bunch of money on this trade, the setup is valid from a technical standpoint. Above $43, this is a 9-year high breakout. I'll leave it at that. Let's go 0 to 5% below the high. There's probably going to be a lot more. 93. We're not going to go through all of these right now. Only have a couple minutes left, but you can see the types of setups that I'm going towards. I'm gravitating towards. AR, they're all generally the same. They don't have to absolutely look the same, but this was the last time we tried to own energy. This was actually a trade that worked, but the last energy trade that we took was net red or net break even. I don't remember. Same idea as Devon. At this point, just cut it in half. Run some fibs. 36. Back to trading view. 2.58 ADR. I'm for a $5 to $6 move. It's a 20% move. See how fast we can do this. The November's price target 35 to 40. I like the 40s. People that are interested in this. I think one thing's for certain. People even like the Januaries. It's going to be hard to fuck this trade up. Sorry for swearing. The energy sector breaks out. I think most of these things are going to work. A lot of them are, at least. I think the hardest part about this is going to be owning the stuff that outperforms everything. And I think that's going to be MPC and Valero. So if you're already in Valero, you got a market-leading name. Congratulations. I think XOM is still an okay trade. It's pretty expensive where it's at right now. CVE is a trade that I think you guys can take with us tomorrow, assuming they don't pop up. I hope they pop up to $1 and you guys don't get them because I'm selfish. But if they don't, CVE is a good trade. Go through this really fast. Guys, I'm hopping off in about 2 or 3 minutes. If you have questions, post them right now. It takes about 30 seconds for me to be able to see them. So I think we have 3 or 4 trade ideas already that we came up with right now, live, that you guys can take with us. We're in Seadrill. This is a shares trade. A bunch of you guys are in SM. It's down after hours. I don't know why, but it's still free trade. Here's one of those names that we were talking about that doesn't move very fast. It ended up being a really good trade for us last year, 2 years ago. I traded this with Mike. You can see that we originally bought the $80, but look at this. Just it takes forever to get this stuff to move, and then for whatever reason, out of nowhere. So if you're playing around with these lower ADR names, you really have to have the expectation that they're going to take a while. So buy time, and don't get discouraged if they don't work right out of the gate. I have a 400% win on JP Morgan right now that I opened in January, and for the first 3 weeks it was red. It wasn't like kicking me out red, but it didn't work, and it just sat there, and it was frustrating. And now it's it was 500, now it's 400. CVE. What contracts? Thanks, Joey. Appreciate it. The September 25s, $25 calls, we got filled in between 50 and 55 cents. I got the 55 center filled. Once again, no idea if this is going to work or not, but man, we're getting a hell of a discount on the CVE contracts, and it's at the right price point on the chart. So once again, I'll pull up CVE and you can see. It's a BRB setup. It's as easy as that. Doesn't mean it's going to work. All I know is we got a discount on a stock that was breaking out, pulled back today with the rest of the energy sector. This is the type of stuff we want to own. All right, guys. Hopefully this helps. If you have any questions, this is going to be reposted. I think it's posted automatically on YouTube. I think it needs a couple seconds to render, or not render, process or whatever. But you can leave comments below on the YouTubes, and I'll answer them. If you're interested in any of our services, links are below as well. I do encourage any of you guys that have full-time employment, 9-to-5s, companies, etc., that don't necessarily have time to sit in Discord all day, every day, but want help leveraging kind of what we do, trade ideas, etc. Our market research portal is great. I put a lot of time into writing up all these trade ideas, 1 to 2 emails per day. We do a bunch of internal webinars. We have 3 to 5 of these per week, actually. You can join any ones you guys want. They're all recorded and reposted as well. It's cheaper than most other services that offer the same type of stuff, and I enjoy doing it. So if you want to be able to leverage the things that we trade inside of the Discord, but you don't have time to sit in Discord, this is a great opportunity for you. Links below. If you do want to apply for the Trader Development Program, link is below as well. I will read through your application. If I think I can help, I'll reach out to you. If not, I'll point you in the right direction. Guys, I appreciate your time. I hope you guys enjoy your Thursday, and fingers crossed for a fantastic next few years for energy. I'll catch you guys in the next webinar.